All right, we're going to cover the moving average strategy, and we're going to go deeper with it because now we're going to talk about it. Price breaks below the 20 EMA and starts heading down to the 50 EMA in a bull market. We're trying to look for entries in a long position going with price, and we're going to do a demonstration and back test whether this thing is worth pursuing or not. We do use Fibonacci and Trendlines to help us decide to get in on a particular level or not. So let's get started. In this presentation, we're going to use a 10,000 tick chart and a 1,000 tick chart to magnify in on the trade entries. And we're going to be using, like I said, the 20 EMA and the 50 EMA. And the rule is whatever direction they're going in is the direction that we are going to trade in. In this presentation, it's a bullish upward trade. So we want the 20 to be above the 50. And we don't want the 20 to cross down below the 50. All right. So let's take a look at all the different situations as we backtest this theory, taking a bull trade, a long trade, when price pulls back to the 20 and pulls back to the 50, what that looks like in magnification and how we would enter in on a trade, the trades that work, the trades that don't, and look at the strategy and the setups and learn from this. All right, so this is the moving average strategy. Like I said, we use Fibonacci levels on the pullback. And we use trendline breaks to determine when to enter in on the pullback. All right, let's take a look at that right now. All right, in this first example, we're going to see a break-even trade. Let's take a look at that. First, we look at the, we just want to show you real quickly on the 15-minute chart where we're entering in on this thing, because it's important for you to see that this whole area here, this whole area is where we're going to be trading. Starting right over here, we're going to be looking at these first two candles here, and then we look at this red candle here, and then we look at these two candles here, this whole down area here with this down area. We're going to take a look at all this down area here, and we take a look at this gigantic drop here, and we're going to take a look at all that for you and talk about the trend line Fibonacci moving average strategy. Let's continue. Here on the 10,000 tick chart, we see the same area of weakness that we just saw on the 15-minute chart. We're going to look at that red candle, these two red candles, this red candle, and these two red candles. And all of that is the same area that we see right here on this time chart right here in the red box. Okay? The same area except on the 10,000 tick chart. Okay? So we're going to look at everything in this little area right here. All right? Let's continue. First, let's start with this red candle right here. This one candle where we see it go down and bounce back up. We're going to cover that area right there. Is there a trend line break technique that we can use in that area? Here we see right now, we see that same area right here goes down, back up. And we're going to learn that this trade basically is a break-even trade. So where we get in, we have our stop loss, it hit a target up here, we move our stop loss up, and when price comes back down, we break even. And that's the strategy with this. Let's take a look at that a little bit closer up. Here we go. All right, so on this strategy, we're looking for Fibonacci levels. What do we see? We see the 38% Fibonacci level right here. We see a trend line coming down this way. We see candles that test after breaking out, little pintails that test, and it starts to head up. All right, so we look to get long somewhere in here. Here's the detail of how we get long on this. First, we enter in the trade. Once we see the pintails testing, we know that we can get long right there. We put our stop loss either under the pivot or under the last pintail test. Price comes up, hits 1-to-1. It may or may not have ticked us out. We don't really know. This is just a back testing practice here. But what we do know is how we would handle this. We would take our stop loss and come to break even once this area has been reached, and if it didn't get us out, price comes back down, fails, and we are zero, which is better than a loss. So that's why we call this first example a break-even test. What we just saw with that break-even test, it came up like this. That's what we saw on the 1,000 tick chart. That's what we see right here in this little area on the 10,000 tick chart. Okay, this is the same area on the 15-minute chart. Okay, that we looked at before. This little down part and back bounce is the same area on the 10,000 tick chart, is the same area on the 1,000 tick chart that we just looked at. These are multiple time charts giving us a different perspective of what's taking place. Example number 2, what if price keeps going down? Because that's going to happen a lot. It's not always going to bounce on the 20 moving average on the 10,000 tick chart or the 15-minute chart. So here we see another area where things are starting to break. What is it breaking? Well, we see price breaking underneath the 20 EMA on the 10,000 tick chart. The 10,000 tick chart, we're really going to see it break the 50 over here, and we're going to look at all these examples and what we would do with our strategy. But right now, we're talking about this little area right here, these next 2 candles. And what do we see on them? Well, we're going to see price go down and back up on this one. Here's a pintail. So price starts up here, goes down and ends up here. And then it rolls over to the next one and it goes down and breaks the 20 EMA. Now, when it breaks the 20 EMA on the 10,000 tick chart, it is below the 200 moving average on the 1,000 tick chart. Let's take a look at that right now. And we can see right here the 200 moving average coming across this way. And we see how price broke below that right there. So let's take a look at that. First, price rolls is up here. It goes down and back up. It rolls onto the next candle and it closes below the 20 EMA, which is below the 200 EMA here on this chart. And this is where we're looking for trade setups. We don't like to trade if price is below the 200 moving average. We want price to be up here and pulling back up here and going back higher. When price dips this low here and here, and we're watching on the higher time chart to see if the 20 EMA starts to come down below the 50 EMA. If the 20 crosses below the 50 on the 10,000 tick chart, then we are no longer in a bullish trend. We are looking to wait for price to come back up. We want the 20 moving average to come back over the 50, and we want the 20 to be going up over the 50 for the pullback into that range and a trend line break so we can get long. So once price goes down so far that on the higher time chart, the 20 crosses below the 50, then this strategy is it's invalid. So there may or may not have been a trade here. We don't have the luxury of seeing it all done when we're in real time. So we might have been looking at this bouncing off of the 200 here. We might have thought that this is going to break out right here, and if we would have got in, it could have been a little bit of a loss on that one, because if we got in, somewhere up here, it immediately fails. So this one actually could be a loss if we got in on this trend line break right here. Now, if we take our chances and buy on the pullback down here, which I like to do because that means my stop loss is very, very small. When price comes back to the trend line, we hop in and then we do hit a 1-to-1. So that takes a little bit more practice and skill, and it's a little riskier, okay? But that is possible to take those kinds of trades. Okay, so let's look at what's happening on the 1,000 here real quick. We had that down and back up and down again. It tries to go up a little bit and has a big crash. What does that look like on the 10,000 tick chart? Let's take a look at that. On the 10,000 tick chart, we have this right here. We have the down and back up, down, and then it tries to go up and it crashes. That's where we're at right now, okay? It's clearly closed below the 20 EMA, okay? So that's what we're looking at on the 10,000 tick chart. Right here, it's going to be below the 200. It's going to be below the 200 because this is where we were earlier when it went below the 200. Now it's really below the 200 here, right? We're looking, what are we looking for? We're looking on the higher time chart to see if price is still above, if the 20 EMA is still above, right? When it comes down right here, well, the 20 is still up. It hasn't crossed down below the 50 yet, right? So the 20's up here, the 50's over here. And even right here, we're gonna learn that the 20 was still up here and the 50 was right here. That's why this area down here, when it drops so far, is still of interest to us. Still of interest. There's no problem with this dip right here, even though it's below the 20. So let's take a look at that again. on this time chart. Yes, it drops pretty far. It's below the 20 on the 10,000 tick chart. It's going to be below the 200 on the 1,000 tick chart. So let's look for our strategies here. Let's look for some trend line breaks. You know, we just draw as many trend lines as we can. We see this one first, and then it really takes off to the downside. So we draw that one right there. Is there a trade for a trend line break that we could take? I say yeah. And another reason why we like it is because this is at the 62% Fibonacci level. This one was at the 50% Fibonacci level, which I forgot to mention, which we probably should go, make sure we pay attention to that. In this area right here, it was interesting because we had a Fibonacci level. The problem with it, though, is that it didn't give us, we looked at the Fibonacci level right here. There's a Fibonacci level right here, 50% came down to. And there are other techniques where you could buy based on that being your stop loss. But that's not what we're talking about in this video, so we might as well not even really mention it. That's a different strategy. It's the Fibonacci strategy only. Okay, it's not using moving averages. Right now we're talking about the moving average strategy with Fibonacci and trend lines. On the next trade, though, this one goes to the 62% Fibonacci level right here. So that's the next trade we're talking about right now. Let's go look at that again in detail. That's this one right here. Okay, so it pulls back. We got some trend lines drawn. We know that the 20 is still above the 50 on the 10,000 tick. This is pulled back to a really reliable 62% Fibonacci level. We draw our trend lines and we start to think about a trade, right? And I think that this gives us an opportunity. Let's take a look at that. All right. If we were to get in way up here, once it breaks this trend line, or you could just simply say it's breaking this trend line here and consolidating. That's why our stop is always under the consolidation. Once it pushes above, we get in. Our stop loss is down here. This is where the stop loss is, right? This is where the stop loss is. We get in way up here. We're looking for a 1-to-1. This is a 1 risk to a 1 reward. It actually hits the 1 reward and actually hits target 2. So if we wanted to break even, this is how we would do it. Let's take a look at how we would take this trade. We enter here, stop loss is here, target 1 is hit. As soon as target 1 is hit, we move our stop to break even. We hope that price keeps going, and it does. So we got target 2 hit, right? And we could take the trade off there, or take some of our trade off there if we got multiple contracts, or we could just simply move our stop to target 1, which will still get target 1. And when it comes back down, at least we got target 1 filled. There's different ways of playing it, but that's how that trade would be played. All right, so that's a good trend line breakout using Fibonacci, using trend lines, using the moving averages on higher time charts to know that we're still in a bullish trend, and this pullback is nothing to be too scared of yet, right? All right, now we're going to look at this one here. This is the Mac Daddy pullback right here, because this one breaks not only the 20 EMA, but the 50 EMA. And if it didn't turn around and bounce right here, get rest assured the 20 would be coming down underneath eventually. If that would have spiked down and kept going, then it would be a no trade zone for us. Okay, so right here on this area right here, what we're seeing is this area right here, right here. This is the area that we're looking at on that big spike. In fact, we need to come to the 15-minute chart in order to see the Fibonacci levels, right? So when it spikes down, there's 50%, there's 62%. If we didn't come down this far out, we would not even know where Fibonacci was at, because that's how deep that pulled back, okay? And you can see how close to dangerous that is, because on the 15-minute, the 20 does cross below, but we're not using the 15-minute to tell us, the direction. We're using the 10,000 tick chart. Okay, that's what we're using. So let's go back over and look at the 1,000 tick chart when this takes place. This is a deep pullback, so deep that on the 1,000 tick chart, it is very bearish. All right, and these are the trend lines and the potential trades that we could take. If we were right here still on this, we might consider taking a trade right here and keeping a tight stop loss, which would clearly fail immediately. Here's another opportunity right here to take a trade with a stop loss under here. If it spiked up, we would have hit 1-to-1. That would have been okay. No trades in this area. I'm not sure how to draw the trend lines here. If we did, it would have worked, but I'm not sure about that. I'm looking for this trend line from the body of the candle to the body of the candle, ignoring the wick, coming over here, and this is the area of consolidation. You see a breakout, a retest, and it takes off. So this is the area that we're going to go long on, okay? So we have a stop loss under the pivot. We have an area to get in. We have our first target hit right there, okay? So that's a successful trade right there. Now we're looking at this example here. Price, we were profitable on that last trade. Price was closing back above both moving averages, which is a great sign, but yet it's dipping down in between again. So it's dipping down one more time. Let's take a look at what that looks like on the 1,000-tick chart. Of course, it's going to be below the 200 moving average because price is below the 20 EMA. And so really, I don't think I would take any trades in this area until it started to push above, or try to push above. And what we see here on the higher time chart is that it does finally push above right here. It starts to push above. I think a trend line would be coming this way. This is the 10,000 tick chart. So let's go back and look at, we would draw a trend line right here on the 1,000 tick chart. We'd look for a break and retest. Price is above the moving averages for the most part. So what we could do, you see what we did here on this trade. We enter long. We have our stop loss here. And our 1-to-1s hit way over here, and it never came to our stop loss. It never came down to our stop loss. So this would have been a good trade. This would have been another good trade right here. All right, so now we get a weakness dip right here. This is the trade that we just took. It was a successful hit. Then we get a little pullback right here, and we're looking down on the 1,000 tick chart. This is the 10,000. Let's go look at the 1,000. This is the perfect ABC pattern. This is really great. You got your A, B, C, trend line, break above the moving averages, green candles, right? We enter long. When it starts to go back up, you got a break and a retest. When it starts to go back up, we get long. Break, retest. Get long when it goes back up. We get long up here somewhere. Stop loss is here. First target, second target, and it goes on for some more targets if we're able to hold it through all that. And what's important about this strategy is that we have to use various time charts or higher time charts, higher volume charts to get a clear direction of which way price is going, so that on the lower time charts, we can set a microscopic, fine-tuned trade setup where we're using trend lines and Fibonacci levels combined with the higher time charts to give us a precise entry trigger, stop loss, and profit target. So that's our moving average strategy here. This is breaking below the 20 EMA on the 10,000 tick chart. And we have another strategy that we don't trade if we're below the 20 EMA. So this one is how the strategy works when it does break the 20 and the 50. So the other video that we made was only covering if price stays above the 20 EMA on the 10,000 tick chart. So I think it's important to know that it's not always going to stay above the 20 EMA. We need to be able to be ready when price breaks the 20 and breaks the 50, and when to stop trying to find a long setup. And we stop trying to find a long setup when the 20 EMA crosses under the 50 on the 10,000 tick chart. That's too deep of a pullback and more than likely a change of direction. All right, I hope this helps. Peace.